let me introduce myself first. I'm Sai. I'm the Chief Product Officer of Finanta, and today I have with me Ron Giacomo. Ron brings with him 35 years as a lawyer, as a compliance and regulatory officer, and he has been providing consulting services to a range of fintech, specifically in regard to compliance and regulatory landscape. Before heading Giacomo Partners, Ron has been the Chief Compliance Officer at Wells Fargo, at JP Morgan, and at USA before that. So he brings a wealth of experience and expertise in the space. Welcome, Ron.
Thank you, Sai. It's nice to be here. Thanks for having me to talk about these issues.
Great. So the specific things we'd like to address today, Ron, are what impact has the new administration had within the regulatory landscape, right? And then I think we'd want to dive into specifically 1071, Section 1071,
Correct.
and related issues, also deposits and funding, and how technology can really help us with some of the changes that are happening and how it can help people navigate the regulatory landscape, right? Let's start with the new administration. How do you see the new administration and what its impact has been so far on the regulatory landscape, and how do you see it going forward?
Yes, the Trump administration has introduced a measure of uncertainty, and I think that's an understatement in the financial services space. Put aside the tariffs and the disruption that's causing. The administration has changed all the heads of the prudential regulators, that would be the OCC, the FDIC, the Fed, as management team, and supervision operations have been affected. And most significantly, the CFPB has essentially been gutted. Very early on, the administration told the workers at the CFPB to put their pencils down and don't do any work at all. And this has created a lot of uncertainty into the market, into what to expect. Financial institutions, like all businesses, rely on a measure of certainty so that they can plan. Without that certainty, it creates confusion in the marketplace. One of the things you talked about was 1071.
Right.
Under the previous administration, 1071, for people, 1071 is a section in Dodd-Frank that required the CFPB to come up with a rule that required financial institutions of all sizes who made small business loans, defined as loans to businesses of $5 million in revenue or less, to collect certain demographic information, append that demographic information to the pricing for the loans if they didn't provide it, provide that information, and send that to the CFPB each year. This was a requirement of Dodd-Frank. The CFPB took 10 years to come up with the rule, and under the Biden administration finally promulgated the rule. As soon as the rule was promulgated, it was challenged in court, particularly here in Texas by the American Bankers Association and the Texas Bankers Association. That wound its way through the courts, and long story short, the federal district court, the federal district court stayed the enforcement of 1071, which would have amended regulation. We have had a whole new section on this data collection. Now, the data that they're talking about collecting is very personal data. It's personal data about the business. It's how much of the company's revenues are there, how many employees, were the company owners members of community like LGBTQ plus community, and gather that information and send that on. The idea under Dodd-Frank was to determine if there was discrimination against primarily minority groups, women, LGBTQ plus communities, and find that out. While it was good intended, we believe, and bankers have all believed, that particularly smaller institutions and medium-sized institutions, this was an incredible burden on the institutions to collect this information, very personal information, and then pass that information onto the government while keeping that information segregated from their underwriting decisions,
Right.
because that could create problems as well. So I think rightly so, the court stated they're re-examining. Now let's come to current day.
Mm-hmm.
Current day, the CFPB has suspended the enforcement of the rule. They have indicated as recently as earlier this month that they intend to rewrite. So we'll see what's going to come out of that. The rule has been uh, compared to the HUMDA rule,
Mm-hmm.
which is similar in that it gathers some information about the sex and gender of mortgage applicants or applicants seeking mortgage loans, and providing that information, and any financial institution that does mortgage lending knows that that's very complicated and often results in a lot of errors. This small business lending was much more complicated than the HUMDA rule in terms of what it had to collect and what it had to report. So I think it's a good thing for these financial institutions, for all of them now, because the court order out of the federal district court really only suspended the rule for the litigants in that case, and that was the American Bankers Association, the Texas Bankers Association,
Mm-hmm.
and I think one or two financial institutions. That was it. So the question is, how far did that extend? That's now all pretty much moot, because the CFPB is basically with essentially withdrawn the rule, withdrawn enforcement of the rule. Now the rules still has to be written because it's still part of the law. Now there is a move to repeal that provision 10 cent from the Dodd-Frank Act, and that didn't get any legs recently, but I don't think that effort is completely over. All right. So that's on the lending side,
Right.
And as we talked, Finanta it's really important that you have a loan origination underwriting system that's flexible enough to capture the information that needs to be collected during the loan application, loan, or underwriting, origination, servicing process.
Yes.
If you do not have a good system,
Mm-hmm.
right, or a system that relies too much on manual processes,
Right.
you're going to be disadvantaged vis-a-vis other institutions, because what we can say, regardless of the administration that's in office, is that there are going to be changes to the regulation, and your loan origination system must be able to be flexible enough and rely enough on technology to be able to accommodate those changes that
Right.
we know are definitely coming.
Yes.
All right. The other thing that having a system like Finanta has is that you're flexible enough to be able to take digital information, applications coming in online, or applications coming in person through the door, which is mostly what small businesses do, is they come into the financial institution when they need a working capital line of credit, when they need a building, construction loan, things like that. So your system is able to accommodate both throughout the process and maintain that flexibility. I think that's going to be very, very important to the future of financial institutions. The other thing that's going to be very important, and it's continuing to be important, is the growth in the digital channel.
Right.
Those institutions who are able to lean into the digital channel to acquire customers, whether they're deposit customers or loan customers, are going to be at an advantage vis-a-vis other financial institutions who do not have the digital presence. So the system that you're looking for must accommodate the digital channel. Many of the core systems don't have that flexibility and are rigid in that. And so financial institutions who have to rely on others to bring that technology in are going to have operating systems that may compete with each other,
right,
or that are running in parallel. You need one system that accommodates everything for you. I think that's the best way.
That's going to help you for sure, given all the changes that are happening. So you see some of these regulations, for example, coming back in another.
Yeah, I think what we're going to see is, I don't think this is the end of it. I think small business lending was a good example. The small business lending rule under 1071 and the change to Regulation B, which added a subsection B, really was a flashpoint for this change. for this administration, and I think the end result is right. How we got there isn't the best thing. You don't just suspend rules. We have an Administrative Procedures Act in this country that should be followed, which means that rules are proposed, they're considered by the public. Public's given an opportunity, public being the general public being interested financial institutions and others, to comment on the rule. The agency considers those comments and then finally writes a proposed rule, and then that's there for a while. That all didn't happen the way it was supposed to happen here. So that's the uncertainty we were talking about earlier. That's difficult for institutions to manage through. So yes, that's just one rule. I do think there are going to be other things that the administration, if they have time, as they get involved, are going to revisit. Now, the one thing that's going to be a particular challenge is the efforts by Doge and the administration to cut costs at these agencies. They're cutting staff. Like I said, the CFPB there's a staff that's cut. That's still up in the air because the courts have now put orders preventing the massive cuts. But these, for the agencies, it's difficult as well. These are people who they have jobs, they don't have places to go to work. The leases of many of these buildings have been terminated and not been renewed. So where does the Fed, where do people the Fed go to work? Where do people the OCC go to work? Where do people the CFPB go to work? And what do they see? That's all been put in turmoil. So there are a number of rules that need constant care and feeding that need to be attended to by any administration just to keep them running correctly. The other part is there's a lack of enforcement with the agencies. Some of the cases institutions have been dropped, simply dropped. And that presents a different challenge, a challenge that all financial institutions are going to face, but particularly small and medium-sized financial institutions, and that is that when the cop on the beat is gone and there is no enforcement by the regulation, that unlevels the playing field.
Yes.
Financial institutions who want to have sustainable business will follow the rules. When your competitors don't follow the rules, it becomes easy for them to gather customers. They don't have to follow the same rules. So we need a measure. We need these agencies there to protect the financial institutions from those that didn't do things correctly. We don't have to go very far back in history. What preceded Dodd-Frank Act was a massive fraud in the subprime mortgage space. Okay, so the danger of not having, I call them cops on the beat, but the agencies to see that these regulations are followed is largely gone right now. And that is going to put immense pressure, competitive pressure on financial institutions who do things correctly. Now, the flip side of that is we can't have a race to the bottom because administrations change. In 4 years, we could very well have a different administration who sees things much differently and will go after the financial institutions for violations of law that they had committed much earlier. 5 years. Okay, the statute.
And you see the community banks, the smaller banks we're talking about, being particularly vulnerable from this aspect.
I think they're going to be particularly vulnerable for a couple of reasons. There are a lot of new new players in this thing, non-banks, that the agencies, all of the agencies, have promoted as a good thing. The FDIC. We're going to get to the FDIC deposit broker rule in a minute. But the non-bank new entrants into these playing fields, the commercial banks who want to get into the small and medium-sized commercial banks or community banks who want to get into this area and partner with these new fintechs, that's going to put pressure on other financial institutions, particularly in the area of digital challenge. The race to go there is going to be competitive. There's going to be the race to stay compliant, or the challenge of staying compliant is going to be very difficult. There simply aren't enough good, enough compliant staff to cover all the financial institutions. I think a lot of small and medium-sized financial institutions already struggle with trying to comply with these laws and regulations that are ever changing. So that's going to be particularly
I
challenging.
think that's one of the reasons there's so much consolidation in the industry,
Right.
especially if they don't have, like you said, like a digital system that can empower them and help them navigate this.
Yeah,
It's going to get all the more difficult.
So that's precisely correct. The digital system, in a lot of ways, moving to digital environment eliminates a lot of error that you have in an analog or face-to-face situation. It's
Manual system.
right with your system. With Finanta system, you're presenting the same information over and over and over. And it's controlled in a digital environment. That's important for financial institutions because they can rely on that system to demonstrate compliance with the rules to the extent that there are rules applicable to that.
Right.
And there are. In an analog or face-to-face environment, you have to make sure you have the right forms. You have to make sure that the person who is asking the questions receives the right training. Turnover in these small financial institutions is pretty high, or can be pretty high. Not always, but can be pretty high.
And you mentioned data segregation.
Data segregation in a very small financial institution is a difficult thing.
Right.
A lot of times, these small financial institutions wear many, many hats, right? And so if you're the chief risk officer, you're the chief underwriting officer, and you might also be assisting with market and bringing in customers. All of that, is conflated in a lot of small and medium institutions out of economic necessity,
right.
Particularly in smaller markets. So it's very important that these institutions start to look at and lean into some of the digital solutions that are going to help them with their compliance, but also in a very short order help them economically, help them compete with larger players by getting the right systems in place to leverage the economies that you can get from a digital environment that you cannot get in a branch.
We did talk about, and you mentioned just a while ago about like the deposit space as well.
Correct. That's another area that, and what you're referring to, Sai,
yes,
is the FDIC came out with a rule on broker deposits. Now, the broker deposits rule had a couple of pretty big exceptions in it. One exception says you're not a deposit broker if you have an exclusive relationship with a financial institution. So the classic example is a fintech, a single fintech raising deposits for a financial institution. Under the current broker deposit rule, they would not be deposit brokers if their business primarily was not business purpose was not primarily deposit brokering. They had other services that they provide, technology services, for example. They wouldn't be deposit brokers. Last year, before the administration switched, the FDIC issued a proposed rule that changed that eliminated those two, largely eliminated those two exceptions, which would have made deposits gathered by fintechs, for example, in those exclusive arrangements, broker deposits, which, as we know, you can only take deposits if they're brokered, or you can only take brokered deposits if you are a well-capitalized institution, fully capitalized institution. If you are not, you need permission to get that, and that's largely not granted. And it also carries with it premium for those deposits, a premium higher than the normal FDIC insurance premium. Now, the challenge to the broker deposit rule by the industry was you didn't give us a reason why you're doing this. And quite frankly, the reason was painfully obvious to anybody who's been watching this for a long time, is the FDIC was getting around to examining these institutions and these bank partnership relationships and couldn't get them on. Realized that a lot of them weren't executing their oversight responsibilities over these fintechs, that they were exposing the financial institution to quite a bit of compliance risk, regulatory risk, litigation risk that they violated their deceptive acts and practices. And one tool that the FDIC had was, well, these relationships are being funded by broker deposits. Essentially, what would be broker deposits but for these exceptions? So the fastest way to slow things down, to slow the growth, was to change the rule. It wasn't to get out and hire more FDIC examiners to put these institutions under consent order to have those informations. It was to change the rule. And that's the stated purpose. Now, nobody talks about it that bluntly, but that's essentially what it is. And it was very effective. Now that that's gone, you can see the resurgence of the fintech bank partner relationships. That is going to put pressure on small, medium-sized financial institutions to have the systems necessary to be able to accommodate that. Again, lean into that digital presence, lean into an automated system that's going to be able to give the institution the flexibility it needs to compete in a way that's economically advantaged.
So I think the last question we had is: do you see some of the states coming up with regulations? So now that the feds are dialing down on some of this soft peddling enforcement, you see some of the states like California and New York stepping up to meet to fill that space.
Yes, and while I applaud the states that can do that and have the resources, they are few and it's expensive, and they're not the primary promulgators of those rules. For example, the CFPB is now responsible for writing and keeping up with the rules, not the states. Couple of challenges: the states don't have what they call visitorial powers into national banks and federal associations. A lot of institutions that are with that are either the national banks or federal associations, federal savings associations. The states can't see what's going on in those institutions because they don't have visitorial powers. Okay, the OCC will keep them out. That's one thing. Next thing is only the very large states really have the staffs to be able to handle some of the challenges that consumers are going to have with financial institutions if they don't operate properly. That's going to come under their unfair and deceptive acts and practices statutes and misrepresentation. The states aren't going to be able to enforce capital requirements. The states aren't going to be able to enforce risk management rules. They're not going to be able to enforce safety and soundness. They can't do that. What they're going to be able to do is essentially treat the patient after it's been sick. If a customer has a problem and there are enough complaints, they'll investigate that. But that's only after the problem has long been brewing in a financial institution. So it's been more of a reactive kind of approach as opposed to the prudential approach that the OCC and the state regulators take when they're examining the financial institutions in their state.
And what else do you see coming down the path from a regulations standpoint? Do you see the federal government doing anything else?
It's going to be really hard to see what they come up with without much staff. Again, the CFPB is responsible for much of the rule writing on the consumer regulations, laws and not the laws that's reserved for Congress, but writing the regulations consistent with those laws in conformance with the Administrative Procedures Act is going to be very difficult with limited staff. The courts are a little bit mixed right now in terms of can the government fire all the staff at the CFPB? The CFPB has statutory required obligations. It must do certain things every year. And the current administration feels that they can do that with 200 people. I don't see how that we have an effective agency. The CFPB is going to be effective at protecting consumers. And by the way, that's the primary purpose of the CFPB, is to protect consumers, not to protect the financial institutions. It's not to be fair to the financial institutions. It's to protect consumers, just like the EPA is its constituent is the environment. So that's going to be very difficult. I don't know how, I don't know how much effect it's going to have on the OCC or the Fed right now in terms of their examination supervision, but I do think that that's going to be dialed back, has been dialed back considerably. And then you have, the same problems at the Federal Trade Commission, which is responsible for, consumer protection in the marketplace, which extends to financial institutions. The FCC has rules itself that govern um, calls and texts using artificial devices. So there's going to be a lot of with these cuts to staff by the federal employees, it's going to be difficult for them to carry out their statutory obligations to enforce these laws.
Okay. All right. That's as much as anyone can predict at this point in time.
It's going to be a while before we see anything, but I don't know how much work we can do with few federal employees. And the folks that do that are hardworking individuals. They have the right idea in mind. They have gone about their business through changes in administration over the years without being political, and the idea is to carry out the laws. The executive branch, as you know, its responsibility is to execute the laws that have been passed by Congress. The executive branch doesn't get to choose. Right now, it's choosing, and that's creating somewhat of a constitutional issue in the United States. We see it everywhere.
Thank you, John. Thank you for joining us today. I
Thanks,
think your insights have been invaluable, especially within the market segment we're talking about. And please do join us for other conversations. Ron mentioned digital channels. That would be an interesting topic of conversation. We're going to talk about AI and digital lending as well. I think that's the other burning topic of the day. Let us know if there's anything else you'd like us to talk about.
We'll do. Thank you very much.
Thank you.